Malaysia's economy is expected to grow between 4% to 5% in 2024, and this is underpinned by continued expansion in domestic demand and improvement in external demand. The key factors driving growth are, first, better employment and income prospects, which will help strengthen domestic demand. Second, the realization and progress of multi-year projects. Third, improvement in the global tech cycle, which is expected to lead to higher trade activities. And fourth, continued increase in tourist arrivals, which will spur growth in tourism-related sectors. Let's move. Household spending will remain the anchor for growth, and this is driven by continued employment and improvement in income levels, sound financial buffers, and support from targeted government measures. The favorable labour market conditions is the key driver for household spending. Unemployment rate declined to 3.4% in the third quarter and is expected to improve further by the end of 2023. The gradual decline in unemployment was driven mainly by continued expansion in employment. And going forward, strong job creation data suggests that employment will continue to expand. Furthermore, labour participation rate is also at a historical high of 70.1%. These factors would support further growth in income and consumer spending. Moving on to investment. Investment activity will be supported by progress of new and existing projects, for example, in E&E manufacturing and data centers. Investment would also be boosted by factors such as easing labour supply, stabilization of input costs, and implementation of structural policy measures through the NIMP and NETR, which includes projects such as the Kasawari carbon capture and storage and the EV charging stations. I must re-emphasize that these investments are not only important in supporting immediate growth, but also to enhance Malaysia's future growth potential and competitiveness. In addition, tourism-related activities are expected to pick up further. As of third quarter 2023, travel receipts have reached 78% of the corresponding period in 2019. The overall growth projection of 4% to 5% next year is subject to both upside and downside risks. On the global front, slower than expected recovery in external demand is a key downside risk factor. On the domestic front, weaker labour market conditions, more severe shocks from commodity production due to stronger impact from El Nino, and the prolonged plant maintenance could also potentially weigh on the growth outlook. As of second quarter 2023, on a seasonally adjusted basis, Malaysia's GDP had exceeded pre-pandemic levels by more than 10%. The recovery was led mainly by the manufacturing and services sectors. Despite the external challenges, Malaysia's diversified exports and tourism rebound have contributed to the country's trade resilience. Furthermore, the improving labour market provided job and income opportunities, especially for the vulnerable segments. Now let me turn to inflation. In line with the easing cost environment, headline inflation continued to trend lower, averaging at 2% for the third quarter. The second quarter this year, it was 2.8%. Core inflation moderated to 2.5% during the quarter. During the second quarter, it was 3.4%. Mainly due to lower inflation for core services such as food away from home, expenditure at restaurants and cafes, and repair and maintenance of personal transport. The moderation in core inflation is expected to continue until end of the year. Growth next year will be mainly driven by resilient domestic expenditure. Inflation is also expected to remain modest. The ringgit depreciated against the US dollar in the third quarter. This trend was also observed among other regional currencies, due primarily to external factors, including the US monetary policy path. Malaysia's economy today is resilient, notably in terms of our economic fundamentals, robustness of our financial sector, and depth of our financial markets. The persistently strong US dollar is therefore not expected to derail Malaysia's growth prospects. I want to emphasize that the bank remains committed to ensure the ringgit adjusts in an orderly manner, and in the longer term, it should reflect our economic fundamentals. Turning now to the banking system's resilience, as indicated earlier, the banking system continued to play an important role in supporting growth during the quarter. Let me iterate that Malaysia's economic fundamentals remain strong and supportive of growth moving forward. In summary, the Malaysian economy expanded by 3.3% in the third quarter of 2023, driven mainly by private sector expenditure. The 2.6% growth in seasonally adjusted quarter-on-quarter number also indicates a positive momentum in economic activity. For 2024, growth is projected to improve to between 4% to 5%, and this is anchored by domestic demand. The exchange rate pass-through to inflation, that is the amount that the ringgit depreciation affects prices, remains manageable in Malaysia.